Good morning, and thank you for joining us today. Welcome to our webinar on investment education, featuring Denise Burns, Vice President and Head of Investments, and Joey Payne, Vice President and Senior Consultant of Cammack Retirement Group. Please note that we will address questions at the end of the webinar. However, you may submit them at any time via the Questions tab in the webinar software. A copy of today's slide deck can be found in the Handouts tab, and a recording will be made available in the next few days. And now I'll hand it over to Joey Payne.
Thanks, Carrie. As I sent out the note in the email, based on some feedback that I'd received from of our HR contacts within IUC universities, there was a request for additional information as it relates to mutual funds and annuity. For some people, they didn't feel like there was a cleaning of what the differences are. So the presentation today, Denise will start out talking about core underlying investment bonds and some kind of baseline information. And then from there, we will build on adding those investments into mutual funds and annuities and talk about how those are affected by putting them in retirement plans. So with that being said, I will hand it over to you.
Thanks, Joey, and thank you everybody for attending. I hope you can hear me. Kara sent out the presentation. We're going to begin at slide 1, which has the title, Fixed Income Basics. So the object of this webinar is to explain to you the selections that you'll be shown at different meetings to kind of whittle down the selections to something that's a lot easier to understand for your participant and will help to assure success upon retirement. So we start with fixed income. This is the asset class that has the least amount of volatility and can be considered capital preservation. So first you see fixed in cash. These are the lowest risk investments and tend to be low income but capital preservation for your participant. They include money market funds, stable value funds, fixed interest rate funds. The problem with these investments are, although they will not lose money because there is guarantees or there's a net asset value that won't go below a certain point, the fact that they have a fairly low return, they may not outpace inflation, so therefore they should be used kind of, especially for a younger participant, they really should only be used for cash on hand because these investments have considerable liquidity risk. Longevity risk. Another fixed income investment that may be offered on your plan as a separate option is a bond. A bond is debt of a company. It's usually issued by either the government, state, local, federal, or foreign, or by companies. So you're actually lending money to these entities. There's an interest rate associated with the bond, and the price, the return on the bond depends on when you buy the bond. So the yield on the bond equals this interest rate over the price of the bond. If you buy corporate bonds, you get a greater yield because there's a little bit more risk. All bonds have a certain degree of interest rate risk. So if rates fall, for instance, prices increase. If rates increase, prices decrease. But a government bond is really backed by the full faith and credit of the government and therefore doesn't have credit risk. But if you buy a corporate bond, there is a certain degree of credit risk. This risk is usually minimized by diversification. So when you buy a bond fund, there will be a great deal of different bonds in the fund, and that will diminish the credit risk and diversify the portfolio. One of the things about bonds is eventually the bond will be paid off at maturity at par value, which is usually $1,000 per bond. So the mutual fund has a bunch of bonds, so some are constantly maturing, but the point that makes it a little bit more capital preservation-like than growth-like is the fact that you continue to get interest income and eventually the bond is paid off at maturity. On slide 2, we have fixed income basics. So what we're showing here, for instance, the first bullet point is the Barclays U.S. Aggregate Bond Index. So that is a widely used index to measure the performance of your fund. There are several different types of mutual funds that you can buy that are bond funds. Some are actually passive bond funds, and they will actually mirror that index. So if the index is up 4%, the expectation is that that fund will be up 4%, less the expense ratio. But expenses are much cheaper than an actively managed fund. An actively managed fund will manage the fund and the securities within the fund to try to achieve a greater rate of return than the index. When you're looking at bonds, things that are considered in analyzing bonds or bond funds are the duration, which is one of the most important points. So the index fund, as I spoke about before, will have a duration that matches the benchmark. But the duration is a measure that will give you an idea of the sensitivity of the fund towards changes in interest rates. So a longer duration fund, like a long-term government bond fund, will be highly interest rate sensitive and will have more volatility than a shorter duration fund. Yield, we spoke about yield a little bit before, is the income return on an investment. So the yield is constantly changing, but it's the coupon over the current price of the fund. We also have some mutual funds that will use investment-grade corporate debt and some that use high yield. So with investment-grade corporate debt, you will get an additional rate of return above the comparable government bond that has the same maturity. And that additional return should compensate for the investment risk associated with a corporate debt. You know, for instance, if the company defaults. Also used in some funds are high yield bonds. And these are bonds that you see on the right, an example of ratings charts with the strongest AAA, AA, indicating government and government-related securities, to the lowest, C, D, etc. That's the high yield universe. A high yield bond is a bond that is rated below investment grade. It offers a higher coupon and therefore a higher yield due to the fact that it has more risk and more sensitivity to the credit of the company. When you're developing a plan menu, you're also going to consider the equities that you want to include into your plan menu. Excuse me, sorry. Equities are a share of ownership in a company. They have the ability to provide your participant with return in two ways, either growth of the price of the shares or income in the form of dividends. The growth or appreciation of shares usually is the lion's share of the return on equities, and ideally, growth should follow earnings of the company. So as the earnings of the company increase, the share price of the stock and the growth to your participant should also increase. But there is more risk with stocks than there is with bonds because they're perpetual. Nobody's going to eventually pay off the exact number. So you can have some fluctuations. However, for a retirement plan participant, especially somebody that's not very close to retirement, they offer the greatest potential for reward and therefore the ability to eventually have enough money to retire. When you look at stocks, they're very different in size in terms of style and capitalization. So capitalization indicates the type of company. So you'll see large, mid-cap, or medium, and small. And that's determined by the actual capitalization of the shares available in that company. The large companies tend to be names that you're very familiar with, and they tend to be a little bit more mature companies and therefore tend to usually have less risk than medium and small. Small are the smaller companies, which tend to have more volatility, but potentially could have greater return as those small companies move up to large companies and they grow. There's different styles of equity funds. The first being value, and those are companies that are trading less than their intrinsic values. So this is the type of fund where, the portfolio managers are looking for companies that are trading at 75 cents but are worth about $1, let's say, just an example. They tend to pay dividends, and they tend to be a little bit more conservative than growth companies. Blend is a combination of both. That's also called core. And usually a blend or core manager will create a portfolio that has both growth and value stocks, and will usually tilt it depending on what's happening in the economy. So in a strong economy, the fund may have more growth stocks than value stocks. Growth stocks are companies that the expectation is that they're going to have stronger earnings growth than a value company. So that what you're doing is you're buying the company for the earnings growth that you expect to have in the future. So they would tend to be more expensive than value because you're paying a little bit more for the potential that the earnings will increase more than a value company, and eventually you'll get greater appreciation than a value company. We also have different terminology in relation to where the companies are located, domiciled. So domestic funds are funds that usually only invest in U.S. companies. An S&P 500 fund is an example of a domestic fund. An international fund is a fund that only invests in countries outside of the U.S. A global fund is a fund that will pick both domestic and international companies, and the portfolio manager will decide which regions they want to invest in or what regions they want to not invest in. The issue with the global fund, however, is that usually it will have at least 50% or greater in the U.S. because it tends to have their allocations of country have to do with more of the GDP allocations of the global of the world. So when you create a portfolio, the goal is to have securities that are different and are not very highly correlated, so that you could get when one fund does well, the other one may not do so well, and vice versa. So if you invest in a global mutual fund for your international exposure, you may not realize that a lot of the global fund is actually U.S. companies. So it's got less, it's more correlated to domestic fund than an international fund. And then the fund that has the most risk but the most potential for a return of these four categories is the emerging markets funds. These are in countries that, as the name implies, are emerging economies. So therefore, the companies within these countries tend to have a higher degree of risk, but they could considerably appreciate if they become more established and become actually a developed country fund. These are companies in countries like Brazil, China, Russia. So again, it's not as highly correlated with the domestic securities and will be a little bit more volatile than an international company in a developed market. Throughout, in due diligence meetings, as a member of a committee that monitors the performance of the funds, you will look at certain parameters that help you decide whether the fund is actually doing what it's supposed to do. So on this page, we've brought up a few of these parameters and trying to explain why they're important. So the first you see is beta, and a lot of people hear about beta of a company. So if a company has, or a fund has a beta of 1, you can expect that this company will perform in line with its benchmark. So an S&P 500 index fund should have a beta of 1 because it's designed to match the benchmark. An actively managed blend fund that has a beta of 1.3 is expected to perform better or worse, depending on the scenario. So if the benchmark is up 10%, its expectation is a fund with 1.3% should be up 13%. And conversely, a low beta, so if the fund is down 10% and the beta is 0.8, the expectation is you'd be down only 8%. Alpha is a measure that's important for an active fund because active funds have higher expense ratios, and the expectation is the performance will be better than the benchmark, and that's why you're willing to pay the higher expense ratio. So a measure of alpha, a positive alpha of 1, means that the fund has outperformed its benchmark index by 1%. So if you are going to put active funds into a plan menu, your expectation is that you're willing to pay the higher expense because you're expecting that the portfolio manager will deliver alpha. Standard deviation is a number that is used to look at the risk of the fund. So this is the dispersion of the data from the mean. So it's just a measure of the fund's volatility. There are some asset classes that generally have higher standard deviations than others, but what you're looking for is, even in a standard asset class, if you have a fund that has a higher standard deviation than the other, you're going to expect that because of that higher volatility, your return should also be higher. And that is measured by the next indicator, the Sharpe ratio. So the Sharpe ratio is also called risk-adjusted return. So what it is a measure of the amount of return you get per unit of risk or volatility. So high standard deviation, you'd expect that to be compensated for, and you'd expect that to be seen in a better standard deviation measure than other funds. Now, R squared is a measure of style purity, and why this is important is if your participants are deciding what their asset allocation is, you're expecting that if they put a large cap growth stock, they invest in your large cap growth fund, that fund performs like a large cap growth fund and doesn't change its objectives depending on economic conditions. So we also look at R squared as a measure of style purity of the fund. But we also look at other performance measures, some of which are databases, Morningstar. So the investments are measured in terms of performance versus their benchmark, but also performance versus their category. So the category ranking is in Morningstar. So if the large cap growth funds are all ranked against each other, the percentile ranking 1 would be the best, and the least favorable would be 100. So that's something that we look at regularly at our due diligence meetings. We also look at correlation. So we want to make sure that we don't have a portfolio full of funds that are highly correlated. And there are some managers where, and that's where the introduction of other asset managers beyond the record keeper funds is important because it lowers that correlation. So you will find that in some funds of the same manager, and it makes sense. They're listening to the same analysts, they're listening to the same strategists, so they're picking very similar stocks. So they will have a high degree of correlation in terms of security selection and generally performance. So it's important to look at the correlation. And then another measure of risk that we look at, and we show it on our due diligence reports for a 3-year number, but our analysts look at the 3 and the 5 and the 10-year number, is up capture and down capture. Because this is a retirement plan, you have to really make sure that these numbers work, because it's important not only upside performance, but it's important to have funds that are fairly defensive. In fact, generally, you'd be willing to forego some upside for the fact that you want a little bit more down capture or less. And if the market is down 10%, your fund is only down 5%. Because what you want in a retirement plan are strong funds, but funds that are consistent, stay with their objective, and perform well in a variety of economic scenarios. So what you want to avoid is a fund that has a high upside capture, but has also very high downside capture. And with that, I'm going to turn it to Joey to talk about the difference between annuities and mutual funds.
Okay, thanks, Denise. So in many ways, annuities and mutual funds are similar. Both of them provide opportunities to invest in stocks and bonds, money market accounts. Both invest in pools of money that are used to purchase securities, and both can be used to invest in long-term savings, including retirement. So I'm going to give you a definition of mutual fund, and then obviously fixed and variable annuities as well. The mutual fund is an investment made up of a pool of money collected from many investors for the purpose of investing in securities such as stocks, bonds, money markets, and other assets. So you can have a all stock fund, and then if it's an all stock fund, then it's going to be based on the categories Denise gave you earlier, like large cap, mid cap, small cap. And then it may have a style of growth versus value. And then the same thing with bonds and money markets. So they can all be packaged into mutual funds. Now, a fixed annuity is a type of annuity contract that allows for the accumulation of capital on a tax-deferred basis. In exchange for a lump sum of capital, an insurance company credits the annuity account with a guaranteed fixed interest rate while guaranteeing the principal investment. And some of you have heard me use this umbrella analogy. So you see the umbrella there representing the tax shelter that this investment has. A variable annuity is a type of annuity contract that allows for the accumulation of capital on a tax-deferred basis. As opposed to the fixed annuity that offers a guaranteed interest rate and a minimum payment at annuitization, variable annuities offer participants the opportunity to generate higher rates of return by investing in equities and bond sub-accounts. If a variable annuity is annuitized for income, the income payments can vary based on performance of sub-accounts. So these sub-accounts in variable annuities are similar, and sometimes, depending on how you look at them, as mutual funds. And once again, the variable annuity itself is tax sheltered. So how are annuities and mutual funds different? Annuities can provide tax-deferred savings. If you had, say, $50,000, you inherited some money, and you've already maxed out all of your options under your retirement plan, your 403B, 457B, you might be looking for a place to put that money. So typically, and after you look at IRA opportunities, and basically you're looking at taxable investments, you could put the money into a fixed or variable annuity, and that would offer you a tax-deferred environment and you wouldn't pay any taxes until you actually take that money out at retirement, and then you pay ordinary income taxes. The alternative would be is you could actually put the money into an after-tax mutual fund. So in that situation, on an annual basis, any capital gains that are triggered by the sale of investments or the growth of investments in the mutual fund, you actually end up having to pay capital gains tax each year. So the annuity provides an opportunity for a tax deferred environment when you're talking about outside of your retirement plan. So when we look at fees, annuities are offered by insurance companies, and they contain what are called mortality and expense charges. And this is the charge that covers the cost of offering the annuity to the participant. And then inside of that annuity, you also have the investment net expense ratio from the underlying investment. Now, mutual funds have a net expense ratio as well. And that net expense ratio can be broken down into investment fees and record-keeping fees. Mutual funds from outside of retirement plans can also have loads, which are commissions typically charged upon purchase or at redemption. So you can have front-end loads, you can have back-end loads. Now, the key thing here, you see the big umbrella for the retirement plans. The retirement plan itself is tax sheltered, okay? So when you have the annuity in a retirement plan, you basically have, a double coverage. You don't need two umbrellas. Is the analogy here. The one big umbrella is big enough. So you have the added cost of the fixed investment in an annuity, or you have the added cost of the mutual fund inside of the variable annuity, sometimes called a sub-account. And that added layer is not adding any value because your investment is already tax sheltered. Now, in the retirement plan, the mutual funds that we put on the open architecture investment platform, they do not include any kind of sales loads, front-end loads, back-end loads, anything like that, because we are buying with group dollars, and we're able to get a share class that doesn't include those types of conditions. So in the retirement plan, variable annuities are kind of a no-no. If you want to look at, if you Google variable annuity and then put a space and then type in SEC for Securities and Exchange Commission, you'll find a whole slate of buyer beware type of information about variable annuities. Okay, moving on. Fixed annuities and variable annuities are different. Their names are derived from the type of investments they provide. So a fixed annuity offers stability of income and typically a guaranteed rate of return, such as a 1 to 3% return during the accumulation phase. Fixed annuities may provide additional returns above the guarantee amount. Earnings are based on underlying investments. So the insurance company takes all the money that people are paying into the annuity, and then they go out and invest that money. And they're required to hold a certain amount back in reserve, but they do invest the money, and they buy stocks, and they buy all kinds of other investments to generate revenue. And that's what they use to actually credit the investments. So these credits are also called vintages sometimes, and they're based on time periods. So typically, annuities are going to credit your account with a certain rate of return for a period of time. Fixed rate earnings are impacted by interest rates and inflation. In periods where interest rates are high, fixed income returns will typically be high, but the same is the flip side. When interest rates are low, then the earnings may actually be closer to the guarantee amount. So fixed annuities, without being adjusted for inflation, historically have been above inflation. But when you actually factor in inflation, then the growth is typically not enough for having all your money in your retirement account. So fixed annuities can be a portion of your asset allocation for somebody that's on the conservative side, but you certainly wouldn't want to have all your money in a fixed annuity. Variable annuities invest in mutual funds and other type of similar investments. sometimes referred to as sub-accounts, the investments can be proprietary, meaning that there's, basically company funds, or non-proprietary from other such managers such as Vanguard, T. Rowe Price, and other mutual fund companies. Variable annuities offer growth and are tied to underlying investments such as the stocks or bonds that they're investing in. Both fixed and variable annuities contain mortality and expense charges, which may average 1% or more. And that makes the cost of investing greater than in a tax-deferred mutual fund in a retirement plan. So when we talk about different types of mutual fund investments, Denise covered money markets earlier, and then you have fixed income funds, you have government bonds, commercial bonds, international bonds, high yield, investment grade, and then equities. We talked about small, mid-cap, large-cap companies based on either value growth, or you can have index, which is going to be a combination of the two. And then you have specialty funds, which tend to be very volatile, and we don't typically recommend including those in the retirement plan because of the volatility. And then you have balanced funds that are a combination of fixed and equity. And then, they can be based on a certain ratio, or they could be based on the fund's goals. So with the next slide, I'm going to talk about target date funds. And the target date funds, these are the funds that we typically have as the qualified default investment alternative in your plan. And so this is a fund that you can actually set it up so that if there's a default, that this is your default option. And also, you're allowed to actually educate people that if they're not, how these plans work, and, if somebody's not real sure about where to put their money, and at the time that they're enrolling, then you can explain how the target date fund works if they would like to choose to do that. So with the target date fund, what you're looking at is somebody's hypothetical retirement date at age 65. So if you're talking to a 30-year-old, their hypothetical retirement date is going to be in 35 years. And so since this is 2019, you would look for a fund that's close to 2054. And so these funds typically are age banded by every 5 years. So you would round up to 2055, and that person would select the 2055 fund. Now, the other thing you notice in the chart, you see lines that are trending towards the right, moving down. That's what we refer to as a glide path. And at a high level, there's two items that you choose from: to retirement, which is the green line, and then through retirement, which is the gold line. So initially, the green line starts out at about 80% equities and 20% fixed when somebody's younger. And then somewhere around age 40, they start selling off equities and converting it to fixed accounts. And then when you get out to retirement at age 65, that's when it's going to even out at around 40% in equities, and then the rest is in fixed. And so that is to retirement. Now, the gold line actually starts somebody out higher in this example at 90% equities. And then it starts gradually selling off, but not as sharply as the other two account. And then once you get to age 65, it's roughly right around 60% equity, but it continues to drop into retirement, and all the way out to somebody's actually 90 years old, and it's somewhere around 30%. So when we meet with you and talk about target date funds, that's one of the things your committee will have to decide. Do we want funds that go to retirement, meaning you think people will probably take the money out of the plan and move it somewhere else, or maybe you want through retirement, where you think people will actually hold on to the money and keep it until retirement. So we're going to talk a little bit more about annuities, and we look at income options. And we can going to compare fixed and variable annuities and mutual funds. So mutual funds are the most flexible, offering participants the ability to leave the money in the account. Now, I have to stop here, and I have to give you the exception. You probably know this already, but at age 70 and a half, you have to take money out of retirement accounts, IRAs and 403b, 401k accounts. But there's an exception that if you're continuing to work for the same employer that's offering your retirement plan, then you don't have to take any withdrawals as long as you're working, if you're working past 70 and a half. But I'll give you an example. If you had somebody that worked for another university, say in Kentucky for 20 years, and then they started working for your university, and then now they're 72 years old. Well, they'd have to start taking money out of the account they had in Kentucky, but they wouldn't have to take money out of your account because they're continuing to work for you. Now, if they wanted to, they could actually transfer the money, if your plan allowed it, into your plan, and then they would avoid the required minimum distribution altogether until they stop working for you. So that's required minimum distribution. So you can leave it there until that applies. You can make lump sum withdrawals. You can make systematic withdrawals. So when we talk about a systematic withdrawal, this is where you say, give me $1,000 a month, and they'll pay you $1,000 a month or $1,500, whatever your number is, until the account runs out. Or you could base it on a percentage, and you could say, pay me 4% of the account each month. And, well, it's based on an annual basis, but, give me a percentage of the account. The key thing there is making sure that you're not taking out more than what the account's earning, or if you are, you're eating into the principal. And then here's the big kicker is because all the money's still in the account, when the participant passes away, whatever the balance is in the account goes to the beneficiaries. And that's a little bit different from annuities, because with annuities, and we'll talk about here now, they have the lump sum withdrawals and systematic withdrawals. But once you actually set up the annuity, then the payout, what happens when somebody dies is a little bit different. So with annuities, they're going to be the actual restrictions on withdrawals are going to be based on the age of the participant and how much the length of time of the investment. Sometimes that's called a surrender charge. So if you have some of these annuity contracts we've been reading there in Ohio, you had to have your money in the plan for, say, 10 years before you could actually transfer or take it out. If you had the money in there less than that, you tried to make a change, then you could actually have a surrender charge where you're having to pay money out. So that's going to be very important when we start talking about making changes in plans, is that people have to sit down and the advisors have to look at that to see if they're going to face any kind of a penalty if they were going to try to transfer any money. So in an annuity, if the payout has not been triggered, typically the balance of the annuity will transfer to the participant. If the annuity payments have begun, continuing payments will be determined based on choices the participant made. So when you go to annuitize, let's say you're age 65 and you want to set up your annuity, they're going to ask you questions, and you actually have to put this in writing and you make choices. But for people that are married or have a partner, they typically will make a choice of a joint annuitant. So that way the payment continues. If it's a lifetime payment, it will continue as long as the employee lives, and then when they pass away, then there's a continuation of the payment to the spouse or partner. And then depending on, whether it's a full payment or a half payment or a 2/3 payment, these are all choices, and they're actually affected by the cost of the annuity. So, for example, if you only want to leave half to your partner or spouse, it won't cost as much versus a single annuity, or single annuitant, I should say. But if you want to leave the full amount to your spouse or partner, then you wouldn't get as much versus having just the half payment or a single annuitant. Period certain, this is a term that's used for beneficiaries. So you may have, a married couple may have, a husband, a wife, and they do a joint annuity. And then people say, but what happens if, 2 years into retirement, we're hit by a bus? What happens to all the money that we paid in? And the answer is, well, if you chose a period certain, it could be like 10 years, 15 years, 20 years, whatever you chose, that money actually would go to your beneficiaries, typically your children or some other relative or a charity, whomever you decide to leave it to. So that period certain makes sure that people get their money out of their account, but at the same time, there's a cost for adding that period certain on as well. Fixed annuities are similar to variable annuities depending on whether a payout has been established. If so, then the choices made when you annuitize are going to affect what the payouts are. And then the last bullet says both fixed and variable annuities that have not been triggered are subject to the 70.5 required minimum distribution. So you can't just leave the money in there. At 70.5, you do have to start taking some out. So how do we calculate annuity payments? So I'm going to give you some examples. So a fixed annuity could be based on a period of time, like 10 years, or it could be based on a lifetime. So fixed year payouts will consider the number of years, projected investment returns over that time, and then the investment fees during that time period as well. Now, lifetime income, this is what a lot of people are interested in. This is based on the participant's life expectancy, investment return, investment fees, whether you have joint annuitants and period certain. So a male that's 65 is expected to live 19.3 years, whereas a woman that's 65 is expected to live 21.7 years. So, a male that's adding a woman to their annuity, that's going to cost more because they're projected to live longer. Whereas a woman that was adding the same age male, it may not have an impact because at least actuarially speaking, the woman's supposed to live longer than the man anyway. The amount being annuitized is transferred from your account to the insurance company to establish the payout annuity. So this is when, people start to get a little antsy when you start talking about taking an annuity, because you're actually taking that money out of your account and giving it to the insurance company in exchange for a series of monthly payments, in whether it's 10 years or if it's based on your life expectancy for your lifetime income. So, for example, if you had $500,000 and you transfer it to the insurance company and what they call a payout annuity, the payout would be $2,850 per month. And then if you were to add a period certain to it, then that would actually drop it to $2,626. So you can see how when you start putting these provisions onto your annuity payment, then there's a cost associated with that. Now, you got to please note, it says annuity payments are for illustration purposes only. Actual calculations will vary depending on mortality tables, interest rates, insurance products, and overall expenses of the program. So, this is a true calculation based on point in time, but it could vary depending on those factors. Factors in calculating variable annuities is the amount that's being annuitized, the expected rate of return, which is tied to the underlying investment. So if it's a stock fund, if it's a bond fund, those are going to impact what the rate is. Now, some annuities may assume a set rate of return in year one, and then typically there's an anniversary date for that company where they adjust all annuities based on the prior year performance. So that variable annuity payment is going to go up or down with the market and the underlying investment. The mortality of the participant, and then the expenses. investment fees, record-keeping fees, and, if it's a for-profit insurance company, then company profit. So in the example, $500,000 annuitized, and they have a large cap growth fund as the sub-account for the annuity. They may assume in year one that they're going to assume a 4% earnings, and then they're going to adjust that annually based on market returns. So in this example, $2,891 would be your year one payout, and then that would actually adjust based on the underlying investments. This is the third bullet. Both fixed and variable lifetime annuities contain longevity credits. Sometimes these are called mortality credits, which are a bonus derived from the pool of annuitants who died before their average life expectancy. So that's the other thing that comes into play. Somebody that's not expected to, if you're in poor health and you're not expected to live a long time, taking a lifetime annuity might not be the thing to do because once you annuitize, you've given your money to the insurance company, and then based on choices you made, your spouse, partner, or beneficiaries might get that money depending on the choices that you make. Whereas on the other hand, if somebody is in great health and you look at your genes of your parents and other relatives and tend to live a long time, then certainly lifetime annuities could be a bonus because you may end up getting more money out of the annuity than what you put in, which, and that's all based on, averages. Some people live longer than others and some people don't. So, excuse me. I'm going to give you some examples of how somebody that is going to retire might utilize an annuity. So if somebody has $250,000 in a fixed annuity and then $400,000 in a mutual fund or a variable annuity, this is some of the options that they might have. So let's say that we assume that they're going to get $1,500 from their Social Security. And, their goal, they need $4,000 a month to cover all their expenses. And this is all the money that they expect to spend, including going out to eat and, saving for vacations and different things. They want to spend $4,000 a month. So when they subtract out the Social Security, $1,500, they need $2,500 from their retirement accounts. So if you take the $250,000 fixed annuity, that would provide $1,425. So they're actually short $1,075. So this is a real world example of what retirees face, is trying to figure out, okay, how do I make up that $1,075? Well, remember, they had $400,000 in either a mutual fund or a variable annuity. They haven't touched that yet. So one option would be is if they wanted to have it all in a guaranteed income, then they could transfer $189,706 in my example over to the fixed annuity side, and then that would make up that shortfall. Okay, so that's one option. Another option is they could do systematic withdrawals. So systematic withdrawal, in this case, they would say, give me $1,075 a month. So if you multiply that by 12, that's $12,900, and we divide that by the balance of $400,000, then they're basically taking out 3.2%. So 3.2% is actually an acceptable amount. So you see the bullet below that, it says the rate is within 3 to 4%. So the 4% rule is a long and tried and true method of how people take money out of mutual funds and also variable annuities. And this rule of thumb, if you will, was designed to tell people how much money they could take out of an account without using up all the principal. And in the old days, because the fixed rate of returns on fixed investments were higher, that proved to be true for the most part. However, in today's world, where the earnings on fixed investments are a lot lower, some financial advisors are suggesting that really 3% is the amount that you should take out of these accounts if you don't want to run out of money. So the fact that 3.2% is close to 3 this might be, a prudent decision for somebody to make. Now, in the case of the systematic withdrawal, because we didn't annuitize that money, we're just taking out a percentage or a fixed dollar amount each month. Whenever this participant passes away, then whatever's in their account goes to their beneficiaries, okay? Now here's an example where we have the same situation, but we're going to solve it with a variable annuity. So participant, needs $4,000 a month. They're getting $1,500 from Social Security. They're getting $1,425 from their fixed annuity. They need $1,075. So with the variable annuity, you could actually move $185,879 in my example over to the fixed annuity, and you wouldn't move it over. You would just annuitize. So you're going to annuitize the variable annuity. So you're basically telling the insurance company, I want an annuity on this amount of money. So in year one, we calculated the payout to be, $1,075 for that amount. It says income will vary, annual adjustments based on market return of the underlying investment. The balance not annuitized in the account is available to the beneficiaries at death, but the annuity payment at death will only continue if the second annuitant was chosen at the time that the annuity payments began, or a period certain was chosen at the time that and the time frame is not elapsed. So if you had a 10-year period certain, and it's been 12 years since you started the annuity, then there's no money left unless you had a second, a joint annuitant. So the annuity payments may provide participants with a larger payout at retirement versus taking out just 3 or 4%. And so the trade-off is exchanging lump sum transfer to insurance company for return of principal, expected returns, and longevity credits. Participant account balances at death is lower due to the transfer of money to the insurance company for the payout annuity purchases. Systematic withdrawal payments, which you can do from mutual funds and variable annuities, are going to have the full balance to the beneficiaries. And the income can vary based on market returns, or the percentage taken out might be too high. So that's something that you have to watch. And then at age 70 and a half, the account balances, you have to start taking money out of the accounts. So why are fees important to participants? Well, fees affect the overall investment return. Multiple share classes are offered on each investment. Even though there's multiple share classes, the fund objectives, management, underlying investments, it's all the same. It's just a different expense ratio and sometimes minimum investment requirement. Annuities have this mortality and expense charge, which is an added layer for providing the annuity and the guaranteed income, and that's often 1% or more. So I'm going to show you a slide from a research paper that I like to cite. This is talking about somebody that begins saving at age 25, and then the money stays invested until they're 67. So on the left-hand side, this is an example of somebody that has an average salary of like $30,500, and they're investing, from age 25 until 67. And then on the right-hand side, this is somebody that has a salary of $75,000 and starts investing at 25 to 67. I think in the higher ed world, on the left you might think staff, on the right you might think faculty. But this is where it's important. If somebody can save 0.25% or 25 basis points on the left-hand side, then for that low-paid worker, that's $42,000 they would have more in their retirement if they could lower their fees by 0.25%. We've been talking about, 1% added fee in these annuities. So if you could eliminate that 1% fee, that low-paid worker would have $138,336 over their career more by not paying that annuity fee. And then on the right-hand side, you could see that that's $340,147 if you could save that 1% fee over time. So we're getting close to the end and we'll start looking at questions, but the last couple of summary slides I think are really good. Fixed annuities can provide participants with a guaranteed rate of return, a fixed income stream at retirement if they take the lifetime income. At retirement, the participant exchanges a lump sum for their account balance, for a series of monthly lifetime income payments. Variable annuities offer the possibility of higher returns compared to fixed annuities. Income options are similar to mutual funds. You have the lump sum systematic cash withdrawal, and also similar to fixed annuities because you can get lifetime income. Annuity payments are based on the underlying investments over time. Mutual funds provide investment options at a lower cost when compared to variable annuities because they don't have the mortality and expense charges. Income options are flexible, offering lump sum and systematic cash withdrawals. Mutual fund balances may be transferred to an in-plan annuity anytime or upon separation to annuities purchased through another retirement plan, such as another 403B or an IRA. So you can accumulate money in a mutual fund and you don't have the added expenses. And if you actually want to do a variable annuity payout, you can transfer the money to the variable annuity when you retire, and then take the annuity at that point in time. So here's my umbrella again. So this is what we've been talking to you guys about, an open architecture investment platform. So you see the big umbrella that's got all the little retirement plans under it. And then underneath that, you see the type of investments that we're talking about offering in your plans. You know, we'll have a fixed account, but which does not have the big annuity umbrella over it. We'll have low-cost variable annuities where applicable, and then mutual funds. So what we're trying to do is to get rid of the high-cost variable annuities that are in these plans. So that's the end of our presentation. So at this point, I'll ask Kara to come back on, and she can facilitate the Q&A, and I'll ask Denise to come back on as well to help answer any questions.
Hello, Joey. Thank you. The only question that I see here is whether or not the slides can be sent out. And just a reminder that we will be sending out a recording of the webinar along with the slide deck in a couple of days. But if you are looking for the slides today, if you click down into the Handouts tab of the webinar software, you'll be able to download a PDF of the slide deck. And a quick reminder while everyone's still on the phone, if you do have a question for Denise or for Joey, please feel free to submit that via the Questions tab. And I'll hold for a minute to see if anything else comes in. Again, if you have a question that you think of after the presentation, you can also email either of the panelists or myself, and we will make sure that that gets answered.
Yeah, thanks, Kara. So while we're waiting for any questions that might come in, you know, just wanted to provide this, you know, forum for you to get some additional information as it relates to investments. As we've been coming around and talking to your committees, you know, the thing that I stress is, you know, nobody has to be an expert on investments, but you do have to understand, you know, how investments work and how these target date funds work, and what's the process for signing up for the plan, and you know, how things work with the various providers that you have. You know, so far we've had 2 presentations on the phase 1 findings, and I think both of the presentations were really well received, and we have the others scheduled, and we look forward to presenting that information to you and your committees in the next few weeks. So, Kara, I'm not seeing any more questions. A couple of comments thanking us for the presentation. So I think with that being said, we're going to end the webinar. What's that?
Thank you very much.
Yes. So thank you very much. And if you have any questions or comments, please feel free to send me an email. Have a great day. Bye.